Yes, friends, now let us discuss about the circulars, certain clarifications in various chapters, starting with your circular in your levy of GST. So, this circular basically talks about taxability of ESOP options, employee stock options, ESPP or RSU, when it is given by a company to its employees, but company is not directly giving to its employees through its overseas holding company. It is discussed in circular 213 in total and 7th circular of 2024. See, technically, when you talk about your employee stock purchase plan or employee stock option plan, the difference between employee stock purchase plan, employee stock option plan, and when you talk about restricted stock units is typically ESPP and ESOP are the options given to the employees, whereas restricted stock units are a case where only if at all you achieve a particular thing, achieve a particular target or performance, it is nothing but an award given which is contingent depending on employee meeting a particular performance standards. Technically, see, whether it is ESPP or ESOP, employee stock purchase plan or option plans, these are the options given to employees. They can exercise it on satisfaction of basic conditions. Restricted stock units are again the same type. The only difference is RSUs. It is not open for everyone. It is dependent on your performance. If at all you meet a particular performance which is set in the contract, then that will be given to you. It is not open for all the employees. Now, what is happening in this entire scenario? If it is directly given by a company to its employees which is within the employment contract, then it is not at all subject to tax, because it is services by employee to employer in course or in relation to employment. So that is out of it. But what has happened in this particular case? So there is a foreign holding company and there is an Indian subsidiary company, and there are employees of this Indian subsidiary company. Now, employees are of Indian subsidiaries companies. Now, there is an employment contract between the Indian subsidiary company and the employees of Indian subsidiary company, through which they will be getting shares of foreign holding company as a part of ESOP or ESSPP or RSUs. Now, these shares will be given by the foreign holding company directly to employees of the Indian subsidiary company. And for this particular shares given by the foreign holding company to Indian subsidiary company will be giving the reimbursement. So shares will be transferred directly by the foreign holding company to the employees of Indian subsidiary company, between whom there is no contract. An Indian subsidiary company will make the payment in terms of reimbursement. It is in terms of reimbursement. Now, the circular is very categorically said that both are non-taxable. The first contract between the Indian subsidiary company and the employees of Indian subsidiary company is nothing but a contract which is covered by para 1 of your schedule 3, which talks about services by an employee to employer in course or in relation to employment. So even if the shares are given as a part of employee stock option plan or employee stock purchase plan or restricted stock units plan, even if it is not belonging to the Indian company shares, it is belonging to foreign holding company shares, it is not taxable. Therefore, this part, the first contract is not taxable. Now the question comes, what about the shares actually transferred by foreign holding company to the employees of Indian subsidiary company. Between them, there's no contract. The contract is for this entire thing. The contract is between foreign holding company and Indian subsidiary company. So Indian subsidiary company tells that foreign holding company, you please transfer the shares to my employees. I'll give you the reimbursement. This is nothing but transfer of shares. Transfer of shares, which is neither goods nor services in terms of section 2 clause 52 and section 2 clause 102. Therefore, this also is not taxable. The only thing that can be taxable here in this entire transaction, if at all, along with the reimbursement, there is some service charges, extra amount, additional charges. Only and only this amount. This reimbursement is pakka non-taxable, but the service charges, if at all it is taken, if the foreign company tells that for transferring my shares to the employees of yours, I'll be taking the reimbursement, which is nothing but the listed price of my shares plus some extra charges. Only this extra additional charges which is collected by the foreign holding company from the Indian subsidiary company, if at all, the main shares value will not be taxable. Only the additional service charges portion will be taxable, and if at all it is taxable, it would be taxable under RCM. The Indian subsidiary company will make the payment. So that is the discussion of this entire lengthy circular. So this entire thing is given in this entire lengthy circular. Right, don't see the length of the circulars. Never ever see the length of the circular. The essence of the circular will be very, very simple. Now next, there's another circular in the same chapter, levy of GST, where the discussion is all about salvage of the wreck value in the claim. If at all there is a damage of motor vehicle, the insured person will go to the insurance company, and there will be obviously a salvage of the wreck value of that particular damaged motor vehicle, which would be sold later on. What will happen with that? So this is discussed in circular 215, and the number is 215 means in entirety is 215, and 215 circular in entirety, and 9 circular of 2024. Now, what generally happens for insurance companies? The insurance companies who are taking the insurance of the motor cars, if at all there's some damage in the motor vehicles, they will pay for the cost of repairs of the damages to the policy holder. It could be categorized into two categories. The total loss would be paid back, or the partial loss situation. Now, what would be the treatment? Now, let us understand what would be the possible treatment. There would be two possible scenarios. Basically, let us understand both the possible scenarios. If at all, the insurance company tells that we will make the final payment to you after deducting the values which are pre-decided. We will not make payments for something, so for few items which are mutually agreed upon, right? And in such case, what will happen? The insurance company's liabilities will be limited to the insured declared value less the salvage or the wreck value of the motor vehicle. If at all there is a total loss of the vehicle, there is nothing which is left out. It's only scrap. So the insurance company will tell that I will give you my declared value, whatever you have agreed. I will be giving you a particular declared value. My risk is limited to this, less the salvage value in case of total loss. Now please understand that in such a case, the agreement is entered into such a way that why it is not paying for the salvage of the wreck value is because the property, the ownership of the motor vehicle remains with the insured person and not of the insurance company. Whatever is the salvage of wreck, it is not becoming the property of the insurance company. It is the property of the insured. Therefore, please do understand this particular breakage. Insurance company may come out and help that I will be helping you in selling this salvage value or the wreck value. I may help you, but understand that insurance company will just act as a facilitator by giving some competitive quotes for the salvage or the best value, and the insured person is always having an option to sell it in open market. The ownership of that salvage of wreck is remaining with insured company. Insurance company is not going to pay. There is no liability for the insurance company to pay on the salvage value, not at all. It cannot, the deduction of the salvage value cannot be treated as any consideration. Right, so that is the first situation. Second is a situation where the insurance company will make the full settlement of insured declared value, whatever is the as per the agreement, insured declared value, without deducting the salvage of the wreck value. Again, that is very clearly in the contract. In such a case, the property of the salvage becomes a property of the insurance company, and when the insurance company is selling that salvage of wreck, it has to pay output tax. So this is very, very categorically said, and the concept is pretty simple. Insurance company is an insured person in case of motor vehicle. We are talking about, say, motor vehicle. So if at all there is a full loss, insurance company, there are two ways where we are talking about what? It is a case where you are talking full loss. There is a full loss. Only in case of full loss there will be salvage or wreck. Right? Otherwise the property still remains with the insured company. So we are talking about full loss where the motor vehicle is gone. There are two possible options. One, insurance company pays insured declared value less the value of the salvage or wreck. Second, the insurance company pays the full insured declared value without deducting it. Please do understand, in such a case, the salvage or the wreck is the property of the insured. Therefore, and insurance company may help the insured person to get a reasonable quotes for the salvage of wreck, where the insured is having an option to sell through those competitive offers that he is getting, or he might sell it in open market. So in such a case, on the sale value of salvage or wreck, insurance company will not pay any GST. It might be the sale of insured, but insurance company will not pay any GST. So you might ask whether insured person, if at all he is registered, he has to pay GST, but insurance company will not pay GST. In case where insurance company makes a full payment of insured declared value, the property in salvage of wreck, it becomes a property of the insurance company. So in such a case, on the sale value of the salvage of wreck, insurance company has to pay output GST. It's very simple. You have to just understand what is happening. As per the contract, if insurance company is selling that, see, I'll pay you the insured declared value, but not, I'll deduct the salvage or the wreck value because it is your property, you can sell it. And if you're selling it, you might have GST liability. It's not my property. I'm not going to pay GST. I might help you in getting competitive offers. The second case, insurance company pays full insured declared value. The property of wreck or salvage becomes a property of the insurance company, and when it is further selling that salvage of the wreck, it is going to pay GST on the same. So that is in this particular circular. Simple circles. Don't see the length of the circulars. Never ever see the length of the circulars. Concept would be pretty simple. Now we are moving on to the circulars which are dealing with your valuation chapter. Now there's one circular which is circular number 228 in totality, 22nd circular of 2024, which talks about GST on incentive which is paid by Ministry of Electronics and Information Technology, otherwise called as METI, to the acquiring bank. There's already a circular which tells that any payment which Ministry of Electronics and Information Technology which is paying to the acquiring banks for what transactions? For transaction in Beam UPI transaction or RuPay debit card transactions, not all the transactions, RuPay debit card transactions and Beam UPI transactions where the value of the transaction is up to 2000. For small value transactions using RuPay debit cards and Beam UPI transactions. So METI is going to pay an incentive to the acquiring bank An acquiring bank further shares this incentive with the issuer bank, and issuer bank further shares this incentive with the payer payment service provider. So there's something called as payer payment service provider and UPI apps. So it is sharing of incentive. This entire sharing of incentive, this entire sharing of incentive, I'm going to write it as this is sharing of incentive which is paid by Ministry of Electronics and Information Technology, which is nothing but central government. You can tell this as subsidy given by central government, which is not part of valuation. Therefore, it will not attract any GST. Right? It is sharing. Ministry of Electronics and Information Technology will only give it to acquiring banks, and they will further share it to issuer bank, and issuer bank will further share it to payer payment service providers and UPI apps. So this is entirely happening through national payment. This is all in terms of National Payments Corporation of India. This is in a manner decided by National Payment Corporation of India along with decision taking by Ministry of Electronics and Information Technology. So this is entirely by way of National Payment Corporation of India. So this entire thing, all these incentives, be it incentive paid by METI to acquiring banks, which is further shared. So this further sharing will also be treated by a subsidy given by the same METI to issuer bank, which is further shared between payer, payment service providers and UPI apps, which will also be treated like sharing of subsidy. This is nothing but subsidy given by the central government, which is not part of valuation, therefore no GST. But just to differentiate it, this payer payment service providers may pay to third party apps. This may pay to third party apps. Now understand that when it is paying this, sharing this incentive with third party apps, this is not in a manner which is decided by National Payment Corporation of India. Therefore, please do understand, this particular payment by payer payment service provider India to third party apps will not be treated as subsidy by central government. So this won't be treated as, this is not in agreement with the METI and National Payment Corporation of India. It will not be treated like subsidy given by central government. Therefore, it is included in valuation. Therefore, on this particular sharing of subsidy, which is actually who's the service provider? Service provider is the third party apps, and who's the service recipient? Service recipient is the payer payment service providers. So this particular sharing of incentive, which is not in agreement with METI and National Payment Corporation of India, this could not be called as subsidy given by central government. When this cannot be called as subsidy given by central government, it is included in valuation. GST is payable, for which service provider is a third party apps and the service recipient is payer payment service provider. So this is the net crux of this entire circular. So what they are trying to tell, if central government is paying the subsidy in form of incentive, though it may not pay directly, it may pay indirectly. MET is not paying directly to the issuer bank or directly paying to payer PSPs or UPI apps. It is paying indirectly. It is subsidy by government, not part of valuation. But if the same subsidy or incentive is further shared by payer payment service providers to third party apps for the service provided by them, then this is not treated as subsidy by central government. This would be part of valuation. GST would be payable. So this is this particular circular. Now, the next circular, which is of not much use in the long run, because the circular will not be of no use when your invoice management service will come into picture. So that is not as of now, but it will come into picture. Then this would not be helpful. Now, this circular, which is circular number 212 in totality and 6th circular of 2024, it talks about what are the conditions. I mean, what is the evidence for the conditions given in section 15.3, which is all talking about post supply discount. So even if it is post supply discount, you can give a credit note as per section 34, and even that is excluded from the value. But there is a condition that you can reverse your output tax, but with the condition that your customer should reverse proportionate ITC. So as a supplier, if I am giving a discount to my customer, can I reduce that from value and reverse output GST? Yes, supplier can reverse output GST, but recipient has to reverse proportionate ITC. But as of now, supplier has got no system functionality facility to check whether the recipient has reversed the proportionate ITC. So what is the way out? The way out is that in this particular scenario, they have to get a declaration. They have to get a declaration. If the amount of tax is not exceeding 5 lakhs, they have to get a declaration. Normally, they have to get a CA-CMA certificate if the amount of tax is more than 5 lakhs. If the amount of tax involved is less than 5 lakhs, they have to get a undertaking or a declaration from the recipient telling that I have reversed the proportionate ITC. But if the amount of tax is more than 5 lakhs, then they have to get that particular declaration or certificate from the chartered accountant or cost accountant of the recipient telling that this recipient has reversed the proportionate ITC. Now, what would be the content of that declaration, whether self-certified by the recipient or through a CA-CMA? It will contain the details of credit notes. It would contain relevant invoice numbers and what is the ITC reversal that is done, whether that ITC reversal is done through a voluntary payment channel DRC03 or in a return, on which return, etc. The main invoices and the corresponding credit notes and when it is being reversed, whether in return, if return, which return, or whether through voluntary payment DRC03 channel, that particular details has to be given. So this would be helpful for the supplier if at all any notice comes to the supplier telling that yes, you have reversed the output tax. So what happens in case of post supply discount? So post supply discount, which is reduced from value by the supplier can reverse output tax, but with the condition that recipient has to reverse ITC. But the problem with this entire scenario is, what is the proof that recipient has reversed ITC? The evidence that recipient has to give to the supplier that it has reversed ITC is either a self-certificate or a CA-CMA certificate. If the amount involved of tax is less than or equal to 5 lakhs, it is self-certificate. If the amount involved is more than 5 lakh, it is CA-CWA certificate. What would be the content of that certificate? That the recipient, for the invoices on which credit was availed and the credit note on which credit is to be reversed, the recipient has reversed the ITC through these returns or by these voluntary challans. So that would be the content of this certificate. Why this would be required for the supplier? Supplier may require these certificates from the recipient, either self-certified or CA-CMA certified, depending on the value of tax, not the entire value, depending on this particular amount. 5 lakhs is the amount, total amount of tax, CGST, SGST, IGST and compensation cess. Right. If at all any notice comes to supplier in future telling that, see, you have reversed your output tax for post-supply discount. What is the proof that the recipient has reversed ITC? Give these certificates. So that would be helpful. But as discussed, this is relevant only till the introduction of invoice management system, because that would be automatically taken care of when IMS is introduced. Yes, friends, now let us see certain circulars with respect to your exemption chapter, basically dealing with 12 bar 2017 CT rate and 9 bar 2017 IT rate exemptions for services. And the first circular is quite pretty simple circular, which is circular number 228 22 2024, that is 22nd circular in 2024, and overall 228 circular, GST on insurance services. Basically, in insurance terminology, there's a term called as retrocession, which technically means reinsurance, whereby part of the assumed reinsured risk will be given to another insurer or cross-border reinsurer, so sharing the risk. So it is nothing but reinsurance. And when you see exemption notification, there is an when the main insurance is exempted, reinsurance is also exempted. So it is hereby clarified that when reinsurance is exempted, whether it is called as reinsurance or whether it is called as retrocession, which is nothing but reinsurance, both are exempted. A very simple clarification, which means whether it is reinsurance includes retrocession. Now, the next circular basically deals with government services. The question asked in the circular number 228 22 2024 was on GST payment on statutory collections made by RERA. So, when you talk about Real Estate Regulatory Authority, which is called as RERA, Real Estate Regulatory Authority, it is, whether it is a governmental authority, and if at all it is a governmental authority, whether any statutory collections collected by RERA will be subject to GST. Now, you need to have a context when you are going to say this particular point, because when you talk about RERA, what is the function performed by RERA? RERA is an institution or a body which is constituted under Real Estate Regulation and Development Act 2016. It is performing the function of regulating the real estate development and construction, which in turn is falling within the entry number 1 and entry number 2 of 12th schedule. Now please remember this 12th schedule of Constitution, because this will have a connection. So it is a regulatory authority which is constituted under an act, and it is performing the function of real estate development and construction regulation, which is in fact covered in your 12th schedule. Now, in the exemption notification 12 bar 2017 CT rate and 9 bar 2017 IT rate, exemption is given to services given by governmental authority if at all any function is performed by them, which is a municipality function by them. If government is performing municipality function or your panchayat function, it is not at all supplied. But now governmental authorities performing any municipality function which is as per your article 243W. And when you have to see article 243W, it has to be read along with your 12th schedule. First of all, interconnect both. Is RERA a governmental authority? Yes, RERA happens to be a governmental authority. So first condition is satisfied. It is service given by a governmental authority. Second, with where 90% control is by government. Second, whether it is performing a municipality functions as per article 243W of your constitution. Yes, article 243W of a constitution has to be read along with 12th schedule, and 12th schedule entry number 1 and 2 talks about regulation of your real estate development and construction. So it is very much covered within this. Therefore, any statutory collection collected by RERA is exempt. By which entry? Given services given by regulatory authority, RERA is a regulatory authority, and municipality related functions under article 243W. Yes, the function which is performed by it is a municipality function, because when you see article 243W, go to 12th schedule. In 12th schedule, you will find these activities. Right. Now, the next two circulars are all about your educational institution. So these entries are That in educational services, we are discussing circular number 234 in totality on 28th circular of 2024. Now, both the circulars are related to affiliation services. Please understand that when you're talking about affiliation services, the first circular talks about affiliation services given by universities to colleges. Second part of the circular talks about affiliation services given by central and state educational boards to schools. So first is university to college, and second is your central and state educational board or councils to schools. Please understand that when you talk about your affiliation services, when it is given by university to colleges, so first is all about colleges. Second, when it is given by central or state educational boards or council to schools. So the first part of affiliation services, that so and so college is affiliated to so and so universities, and so school is certified by CBSE or state board and all. Affiliation services. So affiliation services by university to college, you will not find in any exemption. It cannot be said to be it is related to admission of a student in any colleges. It is taxable. Rather, both are taxable. There's no exemption. The only exemption which is given is for schools when it is given by affiliation is given by central or state educational boards or councils to government controlled schools. To government controlled schools. So only this area is exempt. So affiliation services given by university to colleges is taxable. Educational boards to schools is taxable. But if at all it is given by central and state educational boards or councils to government run schools, it is exempt. When I tell government run schools, they have defined, I mean, this is a new entry which is there in your exemption. So this is related to your amendment. So when I tell government run schools, this is because of the new entry which is added. It is schools which are established or owned or controlled by central government, state government, union territory or local authority, or governmental authority or governmental entity. So this is a new entry which has been added. That is about affiliation services. Another clarification in the same circular with respect to services given by Director General of Civil Aviation, DGCA, when you're talking about airlines, and their approved flying training courses which are conducted by FTOs, flying training organizations. The courses are also approved by DGCA, and the organizations, flying training organizations, are also approved by DGCA. Now, is it exempted? The answer is very simple. Yes, it is exempted. And the reasoning is simple. The reason is when you see your educational entry, you would find that education as a part of curriculum for obtaining a qualification recognized by law is exempted. Education categories are three: preschool education, education as a part of curriculum for obtaining qualification by law, and skill development courses. So here, education as a part of curriculum for obtaining a qualification which is recognized by law is exempt. And please understand that when you talk about your flying training courses, they're all approved courses by Director General of Civil Aviation, and the flying training courses are conducted by flying training organization which are also approved by Director General Civil Aviation. And without this, you cannot get licenses, whether private pilot license or commercial pilot license. Any person who want to get a license for flying the airlines, he will not get a license. Therefore, it is very clear that these approved flying training courses, which are approved by DGCA, by approved flying training organization, where it is mandatory for any person to get a license, whether private license, private pilot license or commercial pilot license. it is mandated by DGCA to complete that particular certificate. Only then you will get a license. Therefore, it is nothing but it is covered by this entry. Education as a part of curriculum for obtaining a qualification which is recognized by law. Yes, it is recognized by law. Because even when the courses which are run by DGCA are all under law. It is all through what? Section 5 of Aircraft Act, read along with Aircraft Rules 1937. This is all covered by this exemption. Now moving forward, the last two circulars are dealing with your composite supply. So both the circulars are dealing with your composite supply. Circular numbers 234, 28 circular of 2024. One talks about GTA services, one talks about construction services. In GTA services, they have said that services of transportation along with ancillary services like your loading, unloading, packing, unpacking is nothing but incidental or ancillary. So it is part of composite supply. Whatever treatment is there for your transportation charges, the same treatment will be there for your loading, unloading, packing, unloading charges, whether it is FCM or RCM or tax rate, everything would be the same. How GTA's invoicing will not at all affect it. But however, it gives an exception telling that if at all these services are given in isolation, they are not given for transportation of goods. Supposing I am a person to whom services is given by a GTA, but it has got nothing to do with transportation of goods. They are giving me these services not along with transportation of goods but in isolation, then it will not be composite supply. So first they clarify that these are all incidental services. Loading, unloading, packing, unpacking and all these are all incidental services. They will be part of composite supply where the principal supply is transportation charges. But however, if these are provided in isolation, the contracts are itself separate, then it might not be part of composite supply. The same way they have clarified for construction services that when you talk about construction, at times supposing there's a building which is being constructed and I tell that I want the top floor of that building. So the builder will tell that normally square feet charges is so and so, but if you want the top floor along with per square feet charges, you have to pay me extra charges, which is nothing but preferential location charges. Along with the basic amount for the residential or commercial properties, I'll pay an extra amount, premium amount. That premium amount is nothing but preferential location charges. Supposing I want my house or my office at the top floor of that particular building, I have to pay preferential location charges. Now, it has been clarified that preferential location charges is integral part of construction services. Therefore, it is nothing but principal services, construction service. It is part of composite supply where principal services, construction service and preferential location charges is incidental. So whatever is the tax treatment for the principal service, construction service will be the same amount for preferential location charges. If the construction amount charges say 2 crores and preferential location charges is say 50 lakhs for the entire 2.5 crores. Whatever is the rate, if it is 5% for entire 2.5 crores, 5%. If it is 12%, 12%. If it is exempted, it is exempted. So it is a part of composite supply. So that is clarified for both. So last two part of the circulars, rather if you see this entire clarification and exemption chapter, last two are dealing with composite supply. And before that, 3 circulars were dealing with your educational services. And before that, you had certain clarification, insurance services and your government services. Right? These are all the circulars which you have in your exemption chapter. Now, talking about circulars in time of supply, there are 2 circulars and both the circulars, there's a common point that they focus on continuous supply of services. The logic of both the circulars is continuous supply of services. Now, the first circular, it is talking about what? Circular number 221 in entirety, 15th circular in 2024. It talks about supply of construction of road along with maintenance when the national highway projects of National Highway Authority of India is given to a party. which is technically called as concessionaire. Under hybrid annuity model, HAM model, it is called as hybrid annuity model. Now, please understand what is a contract of. Contract is not only of construction, but also of maintenance of roads. Given by whom? Given by National Highway Authority of India under hybrid annuity model, where construction payment will be given now, initial payment, and remaining payment will be given over years because maintenance is also required. So this would be operating as build, operate, design, build, and operate and transfer model. So you will be getting an initial big lump sum amount for construction of roads. Thereafter, you will be getting a payment. Supposing the contract is for say 100 crores. So initially you might get say 30 crores or 40 crores, and thereafter the payment will be for over next 15 or 16 years for operation and maintenance. So you'll be getting a lump sum amount for construction initially, and thereafter balance payment. So out of 100 crores, 40 crores you will be getting now, 60 crores you will be getting over a period of 15 to 17 years. The question is, what would be the time of supply in such a case? Now please understand that the essence of the entire hybrid annuity model. So this hybrid annuity mode, please understand this entire hybrid annuity mode is nothing but a single contract, which is not only for construction of road but also for maintenance and operation of that highways. So it cannot be segregated. You cannot segregate that contract. And when you understand it, please understand that this entire thing, construction of roads and operation and maintenance of roads, is falling under the definition of continuous supply of services, where the payment will be made in installments. So it falls within the definition of continuous supply of services. When anything is falling within continuous supply of services, please understand two things will come into picture. First, you have to see what is the due date of invoice. Then in terms of section 13, you have to see what is the time of supply. And this entire discussion we are doing for your continuous supply of services. The due date of invoice normally in case of continuous supply of services is due date of payment as per contract or completion of event as per your contract. The contract is clearly talking about the due date of payment, that is the last date for invoice. If it is not talking about payment, it is about event. If you're completing this event, you will be getting the payment as per contract. Rare cases where there's no due date of payment in the contract or no payment is not based on completion of event, then it will be actual date of payment. Right. So it is depending on the contract whether payment will be paid on time basis or completion of event basis. I'm not talking the last part where nothing is there in the contract, then it is actual date of payment. And time of supply. Time of supply. If invoice is given in time, invoice is not given in time. If invoice is given in time for a service, it is actual date of invoice or date of receipt of payment, whichever is earlier. If invoice is not given in time, it is not due date of invoice, it is date of provision of service or date of completion of service or date of receipt of payment, whichever is earlier. So first of all, you have to understand that in this hybrid annuity model, where you will be getting lump sum payment for construction of roads, highways now, and thereafter it will be annuity. Every year basis you will be getting for maintenance part. Please understand this entire contract for construction of road, highways and operation and maintenance of highways is under hybrid annuity model, which is a single contract. So you cannot bifurcate the contract, therefore it is continuous supply of services. Now please understand these due date of payments will be as per contract. So finally the time of supply will be given in a very simple way for all these national highway projects. First you find out due date of invoice for every payment, for every installment. You do it for every event. You will not do it in entirety. You will divide this continuous supply of services into many events, and you will do it for each event. So you will do it multiple times. Please understand, whenever there is continuous supply of services, you will break that continuous supply of services into multiple events. In this case, first event is construction of road, then every year maintenance charges. So that will be about 15-16 events. First is construction of road, then every year maintenance. So you'll break this into multiple events. And for each of the event, for every such event, first step is finding out due date of invoice. See the contract would be very clear. If due date of payment is given, you have to raise the invoice before the due date, or if due date of payment is not given, it is completion of payment is based on completion of event, you raise the invoice before completion of event, which is there in the contract. And post that, time of supply for each of the event again. If invoice is given in time, you have to raise the invoice before the time given in contract, the last date of payment in the contract, or if that is not given, based on completion of event. When you complete this, you can raise the invoice. If at all you raise the invoice in time, the actual date of invoice, or when you get the payment, which was earlier. Again, please understand that this will be done every time. It is not a single answer for this continuous supply of services. You'll split that into multiple events. And if invoice is not given in time for each of those events, then it is date of completion of service or date of receipt of payment, whichever is earlier. So that is explained in this entire lengthy circular. Also, it is clarified in addition is, if at all any installment is paid late by National Highway Authority of India to the concessionaire or to the contractor, it will pay with some interest, and interest on delayed payment of consideration is also part of the value. So that is already part of valuation chapter. That is very clear from valuation itself. Right. There is another circular which is dealing with time of supply, and this circular also talks about continuous supply of services. The difference is this would be under your reverse charge mechanism. So when you talk about circular 222 16 2024, 16 circular of 2024, it talks about time of supply in case of services of spectrum usage and other services given by your Department of Telecommunication. Right. Now the question is, when you talk about spectrum is allocated to say Jio or Airtel and all, the successful bidder, which is the telecom operator, Jio company or Airtel, will make the payment in installments under a special option called as deferred payment option, which will be given as per frequency assignment letter. This payment will be given in, they will give two options, either you pay totally or you will pay on deferred basis under as per frequency assignment letter, which is given by Department of Telecommunication, Government of India. Now, these telecommunication operators have two options, either making the payment in installments, which is mentioned in the notice inviting application and the frequency assignment letter, and in such a case, what would be the time of supply? They have an option. See, they can make lump sum payment, but they have an option. The successful bidder has an option to make the payment in installment, which is mentioned in notice inviting application. It would be said that you can make the payment in such and such installment, and the frequency assignment letter, which is given by your Department of Telecommunication, Government of India. What would be the time of supply? Please understand that spectrum allocation services is one particular service. Now that it will be assigned over a period of time, so this also is covered by your continuous supply of services. Why? Because the telecom operator will be getting services over a period of time, and it is he is opting to go and make the payment in installment over the contract period in installment. So this would be continuous supply of services, because it is going to be exceeding, the payment is going to be in installment and the supply is going to be for more than 3 months. So it is again satisfying the definition of continuous supply of services. The only change here is, in the previous case, the supplier was the contractor or the concessionaire and the recipient was government, NHAI, forward charge mechanism. But in this case, the supplier is Government of India, Department of Telecommunication, Government of India, and the recipient is telecom operator. Right. So this particular service is covered by RCM. Supplier is government, and recipient is telecom operator. In the previous case, the supplier was the concessionaire or the contractor and the recipient was National Highway Authority of India. So previous case, it was FCM. Supplier was third person and the recipient was government. In this case, supplier is government and the recipient is telecom operator. Therefore, it is covered by RCM. Spectrum services given by Government of India to telecommunication operators is covered by RCM. So this is a case, classic case, which is covered by RCM. Now please understand, nothing changes. What happens in case of continuous supply of services? Even when you talk about your reverse charge mechanism. The first thing you have to find that what is the due date of invoice, which is the same that we have already discussed. Second step is you're going to talk about time of supply for RCM cases, not for FCM cases, for your RCM cases. Again, as discussed, continuous supply of services will be split into multiple events because the payment will be there in installment. What is the due date of invoice? The due date of invoice would be the due date of payment as per the contract. In this case, the due date of payments will be clearly given in the frequency assignment letter. Right? It will be due date of payment. I'm not going to discuss about date of completion of event or actual date of payment. It will be clearly given in the contract. Due date of payment is clearly given in the contract. How you can find due date of payment? If you see frequency assignment letter, that will clearly talk about the due date of payment along with the notice inviting application. So clearly you can find out what is the last date for your payments. And what is the time of supply? Time of supply in reverse charge mechanism is the date of payment in your books or date of payment as per your bank, or 60 days from the date of any invoice or document issued by the supplier. Rather, to be very specific, 61st day, though it is date after 60 days. A day after 60 days, you can write it as 61st day. If you see the legal language, it is a day after 60 days. So you can write it as 61st day of invoice given by the invoice or any document given by the supplier, whichever is earlier. So the difference here is, in this case, the notice inviting application and frequency assignment letter will clearly give you the due date of payment. So first you find out the due date of invoice, which will be the due dates of payment as per the frequency assignment letter and notice inviting application. Later on, you see what is the actual date of payment in your books and bank and 61st day of invoice or supplier. But what is surprising in this circular is what answer they have given is actual date of payment, which is the first part, or due date of payment. Surprisingly, they don't talk about 61st day from the due date of 61st day from the invoice of the supplier. So they don't talk about it. If you see the last part of the circular, actually the answer should have been actual date of payment or 61st day when the invoice should have been, invoice or document is given by the supplier. Actually not even the due date. So here, first of all, due date was not at all required. Directly you could have find out time of supply because it is actual date, 61st day from the actual date or document of invoice. Here one doubt came out whether this frequency assignment letter can be treated as your invoice, which is not. It cannot be treated as your invoice. Now understand why they talk about actual date of payment or due date of payment, because invoice would have been given long back. So the moment they have given the entire invoice, you are getting the facility of payment and installment. That is the reason if you see the last part of the circular, they tell that for the full upfront payment, time of supply is when the payment is made or when it is due, whichever is earlier. And if it is a deferred payment, time of supply would be when the payments are due as per the frequency assignment letter and notice inviting application, or when it is due, which was earlier. The reason for this is invoice would have been given long back, and that is the reason they don't discuss about 61 days. And finally, the circular has clarified that this you don't apply it only for this particular case. In any case where you're talking about any natural resources or anything is given by government to a successful bidder, and where it is continuous supply of services, and where they have option to make the payment either upfront or in installment, you apply the same circular. So in the end part of the circular, you might be confused. You would rather tell that why this due date of invoice is required, because time of supply in case of RCM is actual date of payment as per books or bank, which was earlier on 61st day from the date of invoice of the supplier or any document given by the supplier. Now, why they don't focus on 61st date from any document given by the supplier? Because it would have been given, invoice would have been given long back. Invoice would have been given long back. When invoice is given long back, 61 days would have been over long back. So they tell that it is actual date of payment or the due date of payment, because invoice is given long back. So it is rather a benefit or a concession, which I feel. But strictly speaking, this circular is not in line with the Bar Act or legal language. So they rather give a relaxation, that telling that okay, you don't go with invoice. Government might not have given us invoice. Government is telling that this is notice inviting application and frequency assignment letter, where we have clearly said that you have to make the payments, which means you treat it as any document. You have to make the payments because the language uses 61st day of invoice or document given by the supplier. So this would have been, the time of supply would have been long back. But the circular gives a relaxation, telling that you don't focus on the 61 days at all. So circular ignores the language Bar Act, and it tells that it is actual date of payment or the due date of payment, whichever is earlier, which is beneficial for the assessor. So that is about this particular circular. Yes, friends, now let us discuss the circulars with respect to your input tax credit. There are a lot of circulars when you talk about ITC, but all are simple basic circulars. Now, the first circular talks about what is the time limit in terms of your section 16 subsection 4 for claiming ITC on RCM supplies, if at all they are received from unregistered person. So this is clarified by circular number 211 and /05, that is 5th circular of 2024. Overall 211 circulars, but 5th circular of 2024. Now please understand the question. It is talking about a scenario where it is an RCM supply and the supply is received from an unregistered person. In such a scenario, if supplier is unregistered person and recipient has to pay under RCM, he has to be registered person in terms of your section 24, that is compulsory or mandatory registration. Please understand the fact that it is outward supply for supplier and inward supply for the recipient. RCM, in such a case, the document for RCM would be your self invoice. It would be your self invoice. So this document in this case would be, why I am calling it as self invoice, because normally invoice is of the supplier, but here self invoice will be raised by the recipient himself, and this particular recipient first will pay RCM by cash ledger, and then it will get the credit in credit ledger. First there will be payment, then there will be claim of ITC. The question is, first point that you need to understand is, if at all there is a supply which is made by a supplier who is unregistered and it is liable for RCM, therefore recipient is a registered person, compulsory registration. The document which is required in such a cases will be self invoice, which is raised by the recipient. And in such a case where normally recipient, what they'll do, they'll pay the RCM on your inward supply by cash ledger and then claim the credit because it is an inward supply. Now what is the time limit here? Please understand, the time limit here depends on what time limit, basically depends on the date when invoice or the debit note is raised. So when the invoice or the debit note is raised, in this case self-invoice, then the time limit starts. The time limit is 30th of November of next financial year after the year in which invoice or debit note was raised, or actual date of annual return of that financial year, whichever is earlier. Now, please understand the time limit for taking the credit depends on the self-invoice. If the RCM was that of financial year 23-24, the self-invoice should have been raised in financial year 23-24, and the time limit would be 30th November 2024 or actual date of annual return of financial year 23-24, whichever is earlier. But it might happen that you raise the self-invoice rate. If at all you are raising the self-invoice rate, let us not go with this particular year concept, let us go with month concept. Supposing this RCM was of say February 2024, invoice should have been raised in February 2024, and therefore 30th November of next financial year will be 30th November 2024, right? Because next financial year is 24-25. But if at all you are doing this late and you are doing this in say May 2024, first of all, for raising the invoice late, you will end up paying RCM with interest. For late raising of invoice, you will end up paying RCM with interest. So payment will be of RCM plus interest in terms of your cash ledger, and then you will claim the credit in your credit ledger. Interest will be a cost. So first you will pay RCM with interest, then you will claim IETC, but not interest portion. Interest will be a cost. So if you are raising your invoice late, interest would be a cost. Self-invoice rate. In case where the supply is say of the month of Feb, but you are not raising the invoice in Feb, you are raising it late, you have to pay RCM and take credit. Pay by cash and take in credit. But in such a situation where you are paid late, interest would be a cost. And also secondly, self-invoice is now raised in financial year 24-25. If you are raising it in financial year 23-24, next financial year is 24-25. But if the self-invoice itself is raised in financial year 24-25, 30th November of next financial year will be 2025. So please understand, time limit will also extend. First thing, two important things. That if you are raising your invoice, RCM, self-invoice late, you have to pay RCM with interest and claim the only tax portion, credit portion in credit ledger. Pay the tax with interest by cash ledger, but get only the tax amount in your credit ledger. Secondly, time limit might change because time limit is based on the date when you have raised the invoice. So if you have raised the invoice in financial year 23-24, 30th November 2024, but if you have raised the invoice, self-invoice in financial year, this was financial year 23-24, therefore 30th November 2024. But if you have raised the invoice in financial year 24-25, it will be, because May 24, though the gap is only 3 months, May 24 is financial year 24-25. It will be 30th November 2025. So this is the entire clarification given by this circular that we have discussed. Right. Circular number 211/5/2024. It has connected many provisions, and additional point is, if at all you have raised the self-invoice late, you might also be additionally liable for penalty, that is 122. So it is not only interest, that may be also penalty under section 122. So you may end up paying RCM with interest, and there may be a penalty under 122, but we will claim only the tax portion. Now, the next circular, which is circular number 219/13/2024, 219th overall circular and 13th circular of 2024. It is actually a very basic question, very basic doubt, whether ITC is available on ducts and manholes used in network of optical fiber cables, which is used by telecommunication companies. See, please understand the point. Whether supposing there's a telecommunication company Geo, and it has incurred expenses on ducts and manholes which are actually used for what? Network of optic fiber cables. Nowadays, when you get all those 5G connection or even advanced connection, is all optic fiber cables. So for that, you'll be having ducts and manholes. There'll be manhole, and inside that ducts will be also there. Can you claim the ITC? Now, please understand that here, why this question came up? Because there's a definition of plant and machinery when you see section 17, subsection 5. And that definition of plant and machinery for telecommunication companies tells that plant and machinery will not include telecommunication towers. Basically, you cannot take the credit on telecommunication towers. So doubt arises. On telecommunication towers, telecommunication companies cannot take credit. But can they take the credit on the duct and manholes, which will also be capitalized? Can they take the credit on that? So basically, when you talk about telecommunication companies, whether it is telecommunication towers or whether it is ducts and manholes used in network of optic fiber cables, both will be capitalized. Both will be capitalized. Right? In very normal language, both are in fact plant and machinery. But as per GSE law, as per explanation to section 17 subsection 5 block credit, telecommunication towers will not be treated like plant and machinery. It will be treated like a civil structure, and civil structure, if at all it is capitalized, what will happen? You will not get the credit. Only on repair and maintenance of telecommunication towers you will get the credit. Otherwise, if it is capitalized, you will not get the credit. Now the same doubt came. Okay, telecommunication towers is excluded from the definition of plant and machinery. What about ducts and manholes which are used in network of optic fiber cables? Here clearly plant and machinery definition does not removes it, and they are clearly used for making your outward supplies. That being the case, ITC on the same would be allowed. Right, this entire discussion is based on your section 17 subsection 5 definition of plant and machinery, which is attached as an explanation to section 17 subsection 5. So here very clearly you can take the credit. So telecommunication companies, say for example Geo. So when you talk about Geo or Airtel or any such telecommunication companies, if it is telecommunication towers which is being capitalized, it is removed from the definition of plant and machinery. It will be categorized as a immovable property, normal civil structure, and when it is capitalized, you don't get the credit. But when you talk about your ducts and manholes which are used in network of optic fiber cables, it is clearly within the definition of plant and machinery. Moreover, when it is used for making your outward supplies, an ITC will be available. So this has been clarified here in this particular circular. Now, the next circular, which is circular number 231/25/2024, that is 231 overall circular, and for 2024 it is the 25th circular. What is the situation of ITC with respect to demo vehicles? Now, demo vehicles generally are used by authorized dealers in their sales outlet so that they can provide the trial run for those who are coming and seeing the cars and those who are intending to purchase the cars demonstration purposes. They'll be there for trial runs. If you want to drive and see, if you have any issues, you can tell whether you will find whether that is comfortness or not, etc. So these vehicles are basically purchased by the authorized dealers from the manufacturers against tax invoices, and they will be shown as capital assets in their books of accounts. And finally, after the mandatory period, they have to keep that for mandatory period, they may be sold at a written down value on payment of applicable. When finally they can sell it, when they sell it, they'll be paying the applicable tax. So this is the background. Whether ITC can be available on demo vehicles is the basic question. So the basic question which arises is whether ITC on demo vehicles will be available, assuming the fact that the seating capacity is not more than 13 persons and it is motor vehicles for transportation of passengers. So basically, whether ITC will be able, it is a motor vehicle for transportation of passengers. If the seating capacity is more than equal to 14, then clearly it is available. But seating capacity is less than equal to 30. So seating capacity is less than equal to 30. Can you take the credit? Now please understand, if the seating capacity is less than equal to 13, you can take the credit only in three situations. Basically, you cannot take the credit three situations. If it is used for further supply of such motor vehicles, which means the authorized dealers like we are talking about, or when you are into transportation of passenger sector, or when you are into training sector, imparting training on driving of such motor vehicles. So normally, in a normal situation, when you're talking about purchasing a motor vehicle where the seating capacity is less than equal to 13, you won't get the credit. But only in these exceptional cases, you get the credit. Obviously, when you talk about authorized dealers, you are not covered by this category. Transportation of passengers, they are not covered by transportation of passengers. They are not covered by training or imparting imparting training on driving of motor vehicles. They are not into that sector. They are not into transportation of passenger sectors like the way you have Red Taxi or any other taxi company. They are not into training on the driving of motor vehicles. No. The question is, they are in the sector further supply, which means authorized dealers, they'll purchase, they'll sell, purchase, sell, further supply. And the very interesting point is the term uses further supply of such motor vehicles, not the said motor vehicles. The very important point that you need to focus is they've used the term further supply of such motor vehicles, not that motor vehicle. Supposing an authorized dealer has purchased 100 motor vehicles and he is going to further supply the same 100 motor vehicles. So there will be purchase and there will be sale of all these 100 motor vehicles. Therefore, you can clearly, categorically, you can tell that yes, ITC should be allowed because you are going to pay output tax. But in this case, the same authorized dealer purchases one demo motor vehicle, which will not be sold immediately. It may be sold later. When it is sold after the mandatory period, he will pay output tax. This will be sold later. And whenever it is sold, obviously, whenever it is going to be sold, output tax will be payable. But it is not going to be sold immediately. In other cases, for the 100 motor vehicles, they are purchased for selling it, for further supply. Therefore, you will get the credit. You are going to pay output tax surely. Therefore, you can get the credit when you at the time of purchase. But for this demo vehicle, which is purchased now, it will not be sold now. It will be sold later, and it might happen, might not happen. And if at all it is sold later, you have to pay output tax. That is also clarified. Now, in this case, whether ITC is available is the question. Answer is yes, it is available. It is not further supply of said motor vehicle. That is, this demo vehicle is not used for further supply of. It is not used for further supply of said motor vehicle. This demo vehicle is used for further supply of such motor vehicles. Now understand the difference. Using this demo vehicle, a lot of customers will come, sit in the demo vehicle, have a trial run, like the vehicle and purchase it. So this demo vehicle will in fact push the sales of other motor vehicles. So this particular demo vehicle is not going to be sold. This motor vehicle will not be sold immediately. It might be sold later. Forget about that later part. But this particular motor vehicle is used for further supply of such other motor vehicles. When I tell such other motor vehicles, what is the impact? So this motor vehicle is used for the supply of such other 100 motor vehicles. So it will help in selling those other 100 motor vehicles, because whenever a customer will come, he will sit in the demo vehicle, like the vehicle, then purchase that vehicle. So credit will be allowed. Credit will be very much allowed. You will get the credit. ITC will be allowed. You will pay output tax later, but now immediately you will credit be allowed. Output tax may or may not be paid. So that is the clarification here. But at the same time, this ITC is allowed only for that demo vehicle. Supposing there is same authorized dealer is purchasing one more vehicle, is purchasing one more vehicle for transportation of staff, is purchasing one more vehicle for transportation of staff, which should not be sold. It is only used. Later on it might be sold and all, etc., etc. In such a case, there is purchase of this one motor vehicle for transportation of staff, which should not be sold. It might be sold later, and etc., etc. In this case, ITC will not be allowed because it has got nothing to do with the business. Now differentiate both. When you talk about demo vehicle, using the demo vehicle, there will be sale of other 100 motor vehicles. But using this one motor vehicle, which is used for transportation of staff, it has got nothing to do with sale of. This has got nothing to do with sale of 100 motor vehicles. So here, I'm sorry, here ITC will not be allowed. ITC will not be allowed. In this case, ITC will not be allowed. ITC is not allowed. ITC is not allowed. So your input tax credit would not be allowed. So this is also clarified in the same circular, that only for the demo vehicle credit is allowed. For this particular person, ITC is not allowed. Also, it is clarified that if this authorized dealer is not purchasing and selling these 100 motor vehicles. So what is said, for demo vehicle, we will allow the ITC. For a motor vehicle, which is used for, say, transportation of staff, we will not allow ITC. Even for demo vehicle, there are two categories. If the authorized dealer is involved in purchase and sale of other motor vehicles, then allowed. If the authorized dealer is merely an agent, he's just an agent, and he's not involved in purchase and sale of other motor vehicles, he's not selling it, it's just an agent. In such a case, it is not allowed. So let us understand this situation. Motor vehicle for transportation of staff. So if at all you are talking about demo vehicle, which is purchased by the authorized dealer, which is used for the purpose of purchase and sale of other motor vehicles, so that will be used for further supply of such motor vehicles, then in that case ITC will be allowed. But if that same authorized dealer, though you may call it as authorized dealer, but technically he is only an agent, he is not purchasing and selling any motor vehicle, just showing the motor vehicle, he just get the commission. In that case, you cannot tell that this demo vehicle is used for further supply of such motor vehicles. And if at all this same authorized dealer is purchasing motor vehicle for transportation of its employees or staff, clearly, then ITC is not allowed. Why ITC is not allowed in this case? Because it is motor vehicle for transportation of staff members. It has got nothing to do with further supply of such motor vehicles. ITC will not be allowed. So what is the condition? If at all you are talking about an authorized dealer who has purchased the demo vehicle, which is used for further supply of such means other motor vehicles, only in that case ITC is allowed. Here it will not be satisfying this criteria. In both these other cases, this criteria would not be satisfied. Whether you purchase a motor vehicle for transportation of passengers, they have got nothing to do with, the customers will not come and sit in that particular vehicle. So nothing to do with further supply of such motor vehicles. ITC is not allowed. Even when you talk about an agent who's not purchasing and selling other vehicles, it has got nothing to do with further supply of such motor vehicles. ITC will not be allowed. But in all the three cases, whatever is the case, when these motor vehicles are finally sold, any of these vehicles, they are finally sold, there will be output tax payable. So you have a provision, right? Section 18 has got a provision. Sale of capital goods and plant and machinery, you will have output tax payable, a special formula. Tax on transaction value or ITC minus 5% per quarter or part of the quarter, whichever is you have to compare, and whichever is higher you have to pay. So that will be output tax payable. Whatever is whether you take credit or not. So it is irrespective of the fact whether you take input tax credit or you are not allowed to take input tax credit. This will be the scenario. Right, and please understand, for motor vehicle specifically, if you are not taking the credit, there is a notification that you have to pay output tax. First thing, you have to pay output tax. Output tax rule 18 and by a section 18 and by a notification. So normally, if at all you have taken the credit, it is tax on the selling price or reduced ITC. ITC minus 5% per quarter or part of the quarter thereof, whichever is higher. If you have not taken the credit, then tax will be only on selling price minus your written down value as per your Income Tax Act, and if that is negative, no tax. So that also is all, this is all part of your valuation, but nevertheless, I'm just telling this would happen. Output tax will be paid. How it will be paid and all is not part of the circular. You have to pay output tax. If you have taken the credit, if you have taken the credit, whenever it is sold, you have to pay output tax. Liability is there. If you have taken the credit, it is a different logic. So this, if at all you have availed the credit, then you will be required to go as per your section 18 read along with rule 4046. So that would be giving you an answer like a tax on transaction value, that is selling price multiplied by the rate of tax, or ITC minus 5% per quarter or part of the quarter, whichever is higher. But if you have not taken the credit, there is a notification which gives a relaxation. Now, what is that relaxation which it gives? Notifications of 2018. What is the relaxation that it gives? It tells that you pay tax only on selling price minus WDV value. Valuation will be not selling price minus WDV value as per Income Tax Act. Supposing selling price is 1 lakh, WDV value is 80,000, you pay tax only on 20,000. But supposing selling price is 70,000 and written down value is 1 lakh, which means negative. Selling price is 70 and WDV is 1 lakh. If it is negative, don't pay anything because it will be treated as 0. If it is positive, pay on that. If it is negative, the value will be treated as 0. So that is this entire understanding. And also it is clarified that the fact that the demo vehicle will be capitalized as of no use. Even if it is capitalized, credit will be available. So the fact that it is going to be capitalized is of no use. Goods includes capital goods. And even for capital goods, if they are used in course or furtherance of business, if they are used or intended to be used in course or furtherance of business, credit will be allowed. So this entire thing is clarified. So first is all about ITC. Second is all about capitalization. If you are capitalizing, whether it will change anything, no. Even for capital goods, you get the credit. So that is all about this particular circular. Right. Now moving on to the next circular. The next circular talks about a situation where we are talking about life insurance companies where life insurance policies are given and one portion of the premium is not taxed because of your rule, valuation rules. This is explained in circular 214, overall 214th number, 8th circular of 2024. So what is happening is, in life insurance policy companies, you have valuation rules. In rule 32, sub rule 4, that is the valuation rules where you will remove the savings component. So this entire circular tells that LIC company will pay tax on premiums, on your premiums. Premium contains risk portion plus savings portion, but assessable value will be only the risk portion. So this is clarified in your rule 32 sub rule 4. Now how to calculate risk portion? That is valuation mechanism. It may be the actual risk portion or notional risk portion. So there are some percentages also given, but the understanding is savings portion is nothing but time value of money, remove it. Savings portion is nothing but time value of money, remove it. GST will be paid only and only on the risk portion as per rule 32 sub rule 4, valuation mechanism. If you know the actual risk portion, that value, if you don't know, there are some mechanisms, some percentages will be fixed. Now here the doubt comes that supposing LIC, total LIC is 10,000, risk portion is say about 4,000 and savings portion is say about 6,000. GST will be there only on 4,000. GST will not be there on 6,000. So this is the background. So in life insurance companies, you will pay premium, but this premium contains risk portion and savings portion. And as per valuation rule 32, only the risk portion will attract GST and the savings portion will not attract GST. The question is whether the savings portion, which does not attract GST, is to be treated as exempt supply or non-taxable supply, and if at all it is so, whether proportionate ITC has to be reversed. Now the answer is simple: no, it is not treated as exempt supply or non-taxable supply. It is only deduction from value. It is only deduction from value. The taxable portion is only that much. And if at all it is not treated as exempt supply or non-taxable supply, because definition of exempt supply is not this. Supply is taxable. Supply of life insurance policies where premiums are being paid, it is taxable. Only one part is being taxed. Supply is taxable, but value is removed. Value will tax only 4,000, will not tax 6,000. So only valuation is changed. This entire transaction of premium is collected, the supply is taxable, but valuation portion, one value where you're talking about 6,000 savings portion, that value is removed. Supply is taxable, but value is removed, so it cannot be categorized as exempt supply or non-taxable supply. When it cannot be called as exempt supply or non-taxable supply in terms of section 2 of CGST Act, clearly proportionate ITC need not be reversed in terms of your rule 42 or 43. No need of that. The circular is quite simple. It is not exempt. So supply is clearly taxable supply. One part of the value is removed. Supply does not becomes exempt or non-taxable. Supply is tax. Non-taxable supply means no levy. Exempt supply means levy is that either it is nil rated or it is 100% exempted. So it is neither a case of nil rate, no, nor it is a case of 100% exemption, nor it is a case of non-levy. It is not covered in any of these points. So it is not an exempt supply or non-taxable supply. If that is the scenario, proportionate ITC need not be reversed. You life insurance companies will take full credit. So that has been explained. And friends, the next circular, which is quite a lengthy circular but a simple circular, is all about your warranty. Warranty and extended warranty. This was already there in one circular. ITC and GST liability on warranty extended warranty. This was already there. Explained in circular number 195, 7th circular of 2023, overall 216, 10th circular of 2024. Now certain additions have been done by circular 216, 10/2024. So it was already there. Now certain additions have been done. Now what is the situation? We'll see point by point, and it's very simple. So you have to just focus on what is the situation. Now, whenever you're talking about warranty, if something happens with the product, either the entire product or the part would be replaced, and if at all it is requiring repairs, it will be done. So the original equipment manufacturer, the person who's manufacturing it, will give a warranty to the customer for replacement of parts and for free repair services during the warranty period without charging any consideration. Right. Now, the question is, when the first about the GST liability. So There is a manufacturer and there's a customer. The product is sold. The product is sold. When the product was sold, manufacturer paid output tax. Manufacturer paid output tax. But when the product was sold, selling price, your selling price was not mere selling price, it is selling price plus warranty charges. So output tax was paid on selling price plus warranty charges, both. Right. This is the first part of the transaction. Now, after some time, there's some problem with the product, and there is free replacement of parts or repair services. Either it is free replacement of parts or basic repairs. It has got some problem. Free repairs or free replacement of parts. Now the question is whether manufacturer should pay output tax. Now when I tell free, what is the meaning of this? When I tell free, it means I am not going to collect anything, zero. Now should the manufacturer pay output tax? No, because nothing is being charged from the customer. So when the product was sold, manufacturer paid output tax not only in the selling price but also on the warranty charges. Right. When there is free replacement of parts or free repair service during the warranty period, it's all during the warranty period. Manufacturer is not going to collect anything. He is not going to collect any amount. When he is not going to collect any amount, there's no need of paying any output tax without consideration. There's no need of paying any output tax. Also, the corresponding items for free replacement of parts, there would be some parts or the entire item. When I tell free replacement of parts, it need not be only certain parts, it might be entire product itself. If there is a refrigerator, there may be free replacement of part of refrigerator or entire refrigerator can also be replaced. Now when that item is being used, whether the manufacturer should reverse the ITC, because ITC was availed on these parts or the entire product, should the manufacturer reverse the ITC when this free replacement is given? No. Why? On this part or the entire product which is being replaced, which is being replaced, please understand, manufacturers already paid higher output tax at the time of supply. When he has sold the refrigerator, he has said that I am going to pay output tax not only on the selling price but also on warranty charges. So when he has paid output tax, he has paid on price plus warranty charges. By default, whether he is giving split up as warranty charges or not, he includes warranty charges. He would have calculated warranty. You don't assume that, sir, what if he has not given the split up of warranty charges? Whether or not he has given the split up of warranty charges, he has calculated that how many products would be replaced and he has included that portion. So he has already paid output tax. So when there is an actual replacement of a part or entire product, ITC on which is already availed, there is absolutely no need to reverse the ITC. So two things we are understanding in the same example. First, should he pay output tax? No, free. It is free, you need not pay output tax. Whenever it is free, so normally what is understandable, whenever it is free, you have to reverse the credit. No, in this case, there's no reversal of credit. In this case, there is no reversal of credit. Basically, it cannot be seen in isolation. You don't see it in isolation. It is not a case of gifts of free samples. You don't tell that it is covered by gifts of free samples. No, it is not a case of gifts of free samples. When I tell I'm not paying output tax, the reason for not paying output tax is I've already paid output tax in advance. So when I'm telling I'm not paying output tax, it means I've already paid output tax in advance at the time of sale itself. And when I tell that, automatically, when I already paid output tax in advance, even for the free replacement of the part of the entire product itself, there's no need to reverse the ITC. So what we have understood is both the points. On the free replacement of parts or the entire product itself, no need to pay output tax, and correspondingly for that product or part, no need to reverse ITC. Obviously, if at all I have charged something, supposing if I have charged something, there is some consideration, there are some charges for that product or part of that repair service. If I have charged something, obviously the moment I charge something, I have to pay output tax. So if at all I've given it entirely, I've charged minimum amount, very small amount I've charged, very small amount I've charged. Normally if it's during warranty period, I'll not charge anything, but if I've charged very small nominal amount, the moment I charge anything for that product or free replacement of product or part or for that repair service, on that small charge, whatever I've charged, I'll pay output tax. So if it is free replacement of part of product or free service, repair service, no output tax. And even on the free replacement of product or part or entire product, no reversal of ITC. But if I have charged some amount, pay output tax on that some amount. So that is the entire circular. So we have discussed not only the first issue in the circular, but also the second issue in the circular. And the same thing is there in the third issue. What if the same thing was done by the distributor? So if at all consideration is not charged, then no GST is payable. If at all consideration is charged, GST is payable. Whether it is done by the manufacturer himself or the distributor, same concept. If I have done it free, it is not directly via manufacturer, it is via distributor, same thing. So here, what I can do, whether it is manufacturer or whether it is distributor, right? If it is free replacement of parts, including entire product and free repair services, don't pay output tax. Also, no need to reverse ITC. And if it is some charges, pay output tax. So that is issue 1, 2, and 3 altogether. Now, issue 4 is very critical. Now, what is this issue 4? Now, issue 4 talks about what happens when distributor comes into picture. Why he will give free? Because when he is giving free, technically, why he should give free? As I said, when a distributor is giving to the customer free, no output tax. Same scenario. If he is charging something, pay output tax. But why will he give free? So what actually happens? So there is a manufacturer, there's a distributor, there's a customer. So manufacturer sells to the distributor and distributor sells to customer. Manufacturer pays output tax, distributor takes ITC. Distributor will pay output tax, and obviously if customer is eligible, he may or may not take ITC depending on his eligibility. Right. Now, there is a free, later on there is free replacement of parts. There is free replacement of parts. It can happen through many channels. First, situation 1. Manufacturer, distributor, customer. Distributor gives it free to the customer, but charges from manufacturer. Charges from manufacturer. So distributor will not collect anything from the customer, no output tax. When he's charging from manufacturer, distributor will pay output tax, and your manufacturer will take input tax credit. Because he is a recipient. He is a recipient. Now, supplier is the distributor. Supplier is the distributor. Supplier is the distributor because he is supplying, he is giving it. Out of his own stock, he is giving it. If that happens, supplier is the distributor, recipient is the manufacturer. Though it is given to the customer free, but who's going to pay? Recipient means person who's liable to pay. Person who's liable to pay. Who's paying? Manufacturer will pay. So that is the first scenario. The distributor will pay output tax because he is going to collect it from the manufacturer, and the manufacturer will take input tax return. Right. Second situation. Distributor will give free out of his old stock of manufacturer, right? Free. And manufacturer for this will give a credit note, because he is already having a running account. He'll give a credit note. Now what will happen is when manufacturer gives a credit note, manufacturer is the supplier, distributor is the recipient. So supply was already made. From that supply, output tax was paid, distributor take the credit and distributor give it free of cost. So whenever it is free to the customer, no output tax. Now what will happen? When credit note is given, your manufacturer will reverse the output tax and distributor will reverse the ITC. So distributor is not worried. Okay, you give me the stock. I am giving the stock free to the customer. You give me credit note. See, there are two ways. Either distributor charges it from the customer, where distributor gives tax invoice. So this distributor is giving tax invoice. Here, manufacturer is giving credit note. So if distributor gives tax invoice, distributor will pay output tax and manufacturer will take the credit, though the goods are going to the customer, because recipient is the manufacturer. Or manufacturer tells that you give from your stock, I'll give you credit note. I will reverse my output tax, you reverse your ITC. A third situation may arise. Manufacturer, distributor, consumer. Distributor is giving free out of the old stock of manufacturer. So in all the cases, obviously distributor is giving free out of the old stock of manufacturer, purchased from manufacturer, not of manufacturer, old stock purchased from manufacturer. So rather than writing old stock of manufacturer, better it could be written as from the old stock, obviously purchased from the manufacturer. Now what is happening is, manufacturer will give new stock. Manufacturer will give new stock, but under delivery challan. Whatever stock you have given, I'll give under new stock. Now here nothing will happen. Neither manufacturer will pay output tax. Obviously there's no question of taking the credit. So manufacturer is not going to pay output tax. I'm not going to write about credit. Also do understand that in such a case, manufacturer need not reverse ITC. So this is also clarified. See, there are three ways. Either distributor gives stock free to the customer and charges from manufacturer by tax invoice. So distributor will pay output tax and manufacturer will take credit. Or manufacturer will give credit note to the distributor. So supplier is manufacturer, distributor is recipient. Manufacturer will reverse output tax, distributor will reverse ITC. Or manufacturer will give delivery challan and send a new stock. Now new stock will be sent under delivery challan. So whatever stock you have given free, I'll send you back the stock to the distributor. There's no supplier recipient. Now please understand, manufacturer will not pay any output tax. There's no question of trading any credit by distributor. Also understand that free stock which is being replenished is called as replenishment of stock. Whatever stock is given by the distributor to the customer free, again manufacturer is refilling that stock to the distributor, giving back that stock to the distributor under delivery challan. Manufacturer will not pay output tax. Also, it cannot be said as free samples, because manufacturers, as we have already discussed, manufacturers already paid GST initially when the goods were sold, because selling price directly or indirectly, whether clearly or not clearly, which means whether by split up pricing system or consolidated pricing system, that selling price would have included warranty charges. So why is manufacturer not paying output tax? Because he has paid output tax earlier on warranty charges, and that free replacement will not have any reversal of ITC. So these are the three methods which are explained, categorically explained in this particular circular. So that is issue number 4. Issue number 5. Now if at all, this was all about your replacement of parts. If at all, free repairs is given by the distributor to the customer without any consideration, and he is charging from the manufacturer. Same thing. Now, it is not about free replacement of parts or entire product. It is a free repair service. So, distributor is giving free repair service to the customer, but charging from the manufacturer. Same thing. Now, distributor becomes a supplier and manufacturer becomes a recipient. In such a case, GST would be payable by the distributor to the manufacturer. Why? Now, it is not about replacement of products or entire part. It is free service. Distributor is giving free, but telling that to the customer it is free, but it is collecting from the manufacturer. Just like free replacement of parts, first scenario. Now, who will be the supplier? Supplier will be the distributor. Distributor will pay output tax. Who will be the recipient? Manufacturer. Can it take the credit? Yes, it can take the credit. It can take the credit. Now, finally, we are talking about the last part of the circular, which talks about extended warranty charges. What will happen with extended warranty charges? Now, extended warranty could be categorized as two parts: at the time of supply or after the expiry of initial warranty, whether GST would be payable. Now, this entire thing, please understand, whenever there is a supply, there are three situations which have been explained. Let us understand all the situations. First, the supplier is giving selling the product, and there is extended warranty. At the time of selling the product, extended warranty is part of it, which means the value would be selling price plus extended warranty charges. In such a scenario, it is nothing but composite supply, where the principal supply is sale of product, and extended warranty charges is only incidental or ancillary. So, if in a situation where obviously output tax will be paid by the seller, not only on your selling price, but also on extended warranty charges. Therefore, this entire concept is nothing but of composite supply, where the principal supply is that of the product and extended warranty charges is only incidental or ancillary. This is happening at the time of original supply itself. What if your supplier of product is different from supplier of extended warranty, which means warranty is given by someone else and product is sold by someone else? Now, in such a case, it cannot be called as composite supply. Why? Supplier 1 will pay output tax only on selling price, and supplier 2 will pay output tax on warranty charges. Both these supplies are made by two different persons. Therefore, calling it as composite supply will not work. Composite supply is two or more supplies given by the same supplier. So this could not be categorized as composite supply for a very simple reason. Suppliers are different. So supplier 1 is selling the product, paying output tax on the selling price. Supplier 2 is giving the warranty, extended warranty, and this warranty charges is a separate supply, independent supply. So here, in the first case, when it is composite supply, what is the meaning? Principal supply was supply of goods. So entire supply was that of supply of goods. Here in this case, this supply is that of supply of goods, because supplier 1 is giving the product, and this supply is of supply of service. So rate will be different. Warranty will have a separate rate. When it is composite supply, on the entire value, rate will be that of principal supply. So here there was only one supply, composite supply of goods, only one rate. Here there are two supplies, one supply of goods, another supply of services. Both will have separate rates. So this was the first example. This is the second example. And the third situation, supplier is selling the product initially. The supplier would have paid output tax on only selling price. Later on, the same supplier, after the initial warranty is over, the same supplier is giving extended warranty to her. It would be output tax on extended warranty charges. But what is different here is, this first supply is a separate supply of goods, and second supply is a separate supply, it will be supply of services. Though supplier is the same, it is not at the same point of time. Both are independent supplies. So in this particular scenario, the same supplier, initially when he's selling the product, he'll pay output tax on the selling price plus the initial warranty charges, not the extended warranty charges, supply of goods. Later on, the same supplier, this customer comes later on for the extended warranty after say a year or two. So same supplier will pay output tax on extended warranty charges. This will be treated as independent. This will be treated as independent. Again, this cannot be categorized as composite supply. Why? Because though the supplier is same, but the contracts are different. At the time of supply, there was no extended warranty charges which was offered, or even if it offered, it was not taken by the customer. So it's not that. So the one supply will be treated as supply of goods, separate rate will be there, and after some point of the same supply to the same customer is giving extended warranty by collecting extended warranty charges. It will be supply of services. It will be supply of services. So please understand, whether it is initial warranty or extended warranty, it is only assurance service given. It is not for the product which is going to be replaced. So it cannot be treated as supply of goods. So when I'm charging warranty charges, something may go wrong, may not go wrong. I may replace your parts, I may not replace your parts, I may just repair. So this is only an assurance. It is not for actual replacement which will happen in future. So it is supply of service only. Supply of service only in this case. So these three situations are there. Why in the second case it cannot be called as composite supply? Because sale is done by one supplier and warranty is given by another supplier. Why in the third case it cannot be treated as composite supply? Because sale happens at one point of time, and thereafter independently, after a few months or few years, extended warranty is given at a separate point of time. That is clarified in this particular last part of the circular. Now, talking about the last circular, where what is the background versus C? It is all talking about whether IDC can be claimed by insurance companies for the expenses which are incurred in repairing the motor vehicle in case of insurance claim settlement. So there's some damage in the motor vehicle and the customer is coming for insurance claim, and insurance claim is given. But in the entire process, there are some expenses incurred by the insurance companies. Can it take the credit? So it is circular number 217/11/2024. 217th overall circular and 11th circular of 2024. So insurance companies who are engaged in general insurance services of motor vehicles, they will incur the cost of the repairs and damages and settle the claim either in two modes, either cashless mode or reimbursement mode. Either cashless or reimbursement. Under both the modes of settlement, one thing is common. Insurance company will account the repair liability and claim it as a cost, and that amount will be paid to the approved repair charges to the garage. Whether garage is their network garage where it will be cashless mode or other garage. In both the cases, invoices are generally given by the garage in the name of insurance companies. What happens in cashless mode? Insurance companies directly pays to the approved network garage. What happened in reimbursement mode? Payment of the cost will be first made by the insured person to the non-network garage, then subsequently insurance company will give that reimbursement to the insured. Now, what is happening? There is an insurance company, there is a network garage. insurance company, non-network garage. First is a network garage. For network garage, it might happen in cashless mode. So there is some repair services done by the garage. So supplier is, in both the cases, supplier is garage. Now, what happens in network garage? Directly, insurance company repair services given to the insurance company, and payment is directly made to the network garage. Payment is directly made to the network garage. So garage company will pay output tax and insurance company will take input tax. It is ITC is eligible. We're talking about insurance companies, ITC is eligible. We are not talking about normal companies. For insurance companies, there are exceptions. Whatever is the type of motor vehicle, whether it is less than or equal to 13 seating capacity or more than or equal to 13 seating capacity, for insurance companies, they can always take the credit. They can always take the credit. Now, what happens in case of non-network garage? Repair service is given to the insurance company, but payment, the insured person will make the payment to the non-network garage, and this would be reimbursed by the insurance company to the insured person. Reimbursement model. So to the non-network garage, invoice will always be in the name of insurance company. Invoice will always be in the name of insurance company. But who will pay output tax? Output tax will be paid by the non-network garage. Can insurance company take the credit? Yes, because in both the cases, this is actually called as cashless mode. Cashless mode from the point of view of insured, or reimbursement mode. Reimbursement mode is from the point of view of insured. So in cashless mode, insured will not be coming. So what will happen? Network garage directly will give the invoice to the insurance company. It will take the credit for repair services, and payment directly will be made by the insurance company to the network garage. Right. So in network garage will give invoice and payment will be made. In such a case, ITC will be allowed. Garage will pay output tax, ITC will be claimed. What will happen in reimbursement mode? The non-network garage will give the repair service. Insurance invoice will be in the name of insurance company, but the payment will be made by insured to the non-network garage. Then insurance company will reimburse to the insured person. Again, can ITC be availed? Yes, ITC will be availed only by the insurance company. Now, two other points of clarification which is given. What if I tell that invoice is not in the name of insurance company, it is in the name of insured? If invoice is not in the name of insurance company, ITC cannot be. One of the condition for ITC is invoice. So if I tell invoice is not in the name of insurance company, if invoice itself is not in the name of insurance company, then this entire discussion is of no use. ITC will not be available, because one of the condition for taking the credit is invoice should be in the name of recipient. Who is the supplier here? Supplier here is the garage. Recipient here is the insurance company. But if invoice is not in the name of insurance company cannot be said to be the recipient. ITC cannot be available. So that is the last clarification which is there. And one more clarification is given. What if the non-network garage is giving the invoice to insurance company and partly to the insured, which means the invoice for the repair services. Invoice is given in the name of insurance company, but insurance company is not making the entire payment. So that is the insured person which is coming in between. It is all reimbursement mode. Second mode. Invoice is of say 1 lakh rupees plus GST. So supplier is non-network carriage. Prima facie you feel that recipient is insurance company because yeah. But insured person makes the payment. But only partial reimbursement is there. So this 1 lakh plus GST, supposing GST amount is 80,000. Insured person makes the payment of 1 lakh 18,000, but reimbursement which is received is not 1 lakh 18,000. Supposing it is say 80%. 80% means 80,000 plus GST on 80,000 at 18%. So which would be your 14,400, because only 80% is given. Now, how much payment insured person paid? Entire amount 1 lakh plus GST 1 lakh 18,000. But how much reimbursement it got? Only 18,000 plus your 14,400. Now understand that supplier in this case would have paid output tax 18,000. But how much insurance company can take the credit? Insurance company can take the credit not of entire amount 18,000, but only of the reimbursement of 14,400. So in this case, where supplier is paying output tax of 18,000, but the insurance company recipient can take credit only of 14,400 because only partial reimbursement is made. What about the balance credit 3,600? If insured company, the insured person is eligible for taking the credit, he can take it. But in such a case, he has to ask the non-network garage to give two invoices: 80,000 plus GST to the insurance company, 20,000 plus GST to the insured person. Only if the invoice is split, he'll be able to take it. That is not addressed in the circular, but that is understandable because one of the conditions for taking the credit is invoice. Right? If you don't have invoice and if you satisfy every other condition, credit will not be received. But the point here they wanted to clarify is supplier is paying entire output tax 18,000 on network garage, but insurance company will not take the entire 18,000 credit. It will take only proportionate credit because it has paid only 80,000 plus 14,400 GST to the insured. Insured person paid full amount, so it is only 14,400 credit. Can the insured person take the credit of balance 3,600? If entire invoice is in the name of insurance company, no. But if the non-network garage gives two invoices, one 80,000 plus GST to the insurance company will take the credit of 14,400, and second 20,000 plus GST 18% to the insured. Then the insured, if at all he is eligible, he can take the credit of 3,600. So that is explained in this circular, issue 1, issue 2 and issue 3. So these are all the circulars when you're talking about your ITC chapter.